Happy Friday and welcome back to Live Lunch and Learn. I'm your host, Lambros Demos. And this month of June, we are focusing on ways to manage stress and anxiety. Certainly, there's been a lot of that going on. Last week, we had Dr. Kimberly Wilson on who talked about burnout. But this week, we're going to shift back to real estate. And certainly, real estate has been a stressor for a lot of people. Both working in the industry as well as the consumers, particularly home buyers over the last couple of years, as they've watched prices escalate and escalate and escalate out of control, sometimes crushing their dreams of home ownership. Other times, maybe they had to settle for something less, or other times they've had to pay more than expected. Now, lately, in the last 3 months or so, some of that stress has shifted towards sellers as they've watched prices soften, maybe come down a little bit. And that can be particularly anxiety inducing if they've already bought another house. So certainly a lot of that going on in the real estate industry. And so what do we do about it? One of the ways to manage stress and anxiety is through education, being well informed. So my guest today, he has been in the mortgage industry for the last 31 years or so, and he is a champion of financial literacy. He was on CB24's Hot Property for about 19 years, educating viewers. Now he educates people on Instagram in daily and weekly segments. Please welcome back to the program, Vince Gaetano. Welcome, Vince.
How you doing, Lambros?
I'm doing well, thank you. How are you?
It's been an interesting week. I've been fine. I was happy to be out yesterday volunteering at the RBC Canadian Open out in Etobicoke.
Nice.
Raising some money for the 50-50 draw. They're raising money for the First Tee program, which is wonderful. And I was able to help out and walk the grounds, meet some great people. And it's so nice to see people from across the country enjoying the national tournament.
Yeah.
And just seeing people again. I think the engagement was unbelievable, and it was just nice to see. Beautiful day.
Excellent. Yeah, I'm wearing red and white today for the Canadian Open.
Yes, actually, it is red and white day. I'm not volunteering today. I'm going to be back tomorrow, but that's
good stuff.
It's going to be a lot of fun today.
Well, thank you for being here, and I appreciate you taking time out of your day, especially during the Canadian Open. I know you're a big golf fan, so you could be watching, but you're here, so we appreciate that, and I'm sure my viewers will appreciate it. So, I mean, let's talk about, let's dive right in here and talk about probably one of the biggest stressors in our business right now, interest rates, how they're rising. They went up last month. Actually, I think that was 3 consecutive times they've gone up now. Probably going to go up again in July. And then I think there's 3 more announcements after that. Where do you see this going? What's the Bank of Canada's target rate and how high do you think they can go?
Well, we could do a segment called The Good, the Bad, and the Ugly.
Okay.
Well, there's no question, we benefited during COVID with some of the lowest rates we've ever seen. They hit the bottom, and people had to be aware that there was only one way to go, and that's up.
Yeah.
And not only have they come up, they've come up quickly.
Yeah.
As you pointed out, there was a jump in March, another one June 1st, in April, and now June 1st. So they've gone up a quarter. They've gone up 1.25% in those 3 meetings cumulatively. And what I always point out to people is we haven't even hit what they gave us back in March 2020. So in March 2020, there were 3 rate drops of 50 basis points in 1 month. There's 2 emergency meetings. Okay. So rates on the variable side dropped 1.5%. And we've only given back 1.25%. So we haven't even hit where we were pre-pandemic.
Yeah, a lot of people forget about that.
People do forget because people have short memories. And COVID hung around so long that it seems like ages ago. So I don't blame them. There's just been a lot of stuff that's happened since that we have to remind people. And education is what we try to stress here. So we're always educating people. The stress test could very well be the hero in all this. It was vilified. It was deemed uh, restrictive. It didn't allow people to buy what they wanted to buy, and this qualifying rate was just hated. It
Okay.
could very well be what saves everybody. Okay, people were getting 2% rates, being qualified at 5.25. They couldn't understand why. But the reality is, as we're seeing these rates increase, getting closer and closer to that 525, especially on the fixed rate side, it could help everybody out. And it could help everybody out in a good way if they haven't gone out and blown their brains out buying things and spending on things that
Right.
really aren't helping them. But you add in the added cost of high fuel, high food prices, it really becomes very complex. And I've been taking a look at the 5-year Canada bond market, and it's up 16 basis points today.
Wow.
And for anybody that wants to put things into perspective, the 5-year fixed rate is priced off of the 5-year Canada bond. The banks want some margin between the 5-year Canada bond and the 5-year fixed rate they charge people.
Yep.
It's usually about almost 2%, okay, for costs and whatnot. So on May 30th, the 5-year bond was at 2.65%. Okay, 2.63 actually. Today it hit 3.33. It's up 16.7 basis points today.
Wow.
So we're up 70 basis points, which tells me that the July 13th Bank of Canada meeting could very well see a 3/4 point hike.
So the variable rates usually are in line with the fixed rates, and when they go up, is that what you're saying?
Well, the 5-year Canada bond is an indicator of where the Bank of Canada could be at, and inflation is just moving at a rapid pace. It is not slowing down.
Yeah.
The May inflation numbers are due out next week, and chances are they're not going to be moving backwards. I think April was at 6.8, March was at 6.7. We need that to turn around. We need it to just reverse course.
Okay.
If it doesn't reverse course, the Bank of Canada has only one tool, and that is interest rates. And they have to increase to try to stop inflation.
And you're saying they can go up as high as 2 or 2.25% then? Oh, yeah. Oh,
No, yeah. So we could be at 3/4.
1.5 now, and 3/4 points will put us at 2.25.
Correct.
Right.
Well, let's use the branch rate. Right now we're at 3.7.
Okay.
That's prime. Because the bank rate, nobody pays the bank rate. It's what they charge the banks and whatnot. But the prime rate is 3.7, so we could go up to 4.45.
So do you see a scenario whereby that interest rate would come at or above the stress test rate? And what would happen in that situation? Would they just increase the stress test?
Well, the stress test is the higher of 5.25, or your contract rate plus 2%.
Good point. Yes.
So if you have a 5-year, and Scotiabank, I think, is at 4.99 on a 5-year. A couple other monolines are already bumping up to 5.04.
Right.
Probably get a few more notifications by the end of the day as what we usually get. We'll get notified that rates are up at midnight and effective throughout the weekend and Monday. So if you're looking at a 5-year fixed rate at 4.99, you're qualifying at 6.99.
Right. So people are already qualifying higher than the stress test. If it's at 3
they are
now, right? Yeah.
And it's kind of causing a bit of a problem because people that can't qualify on a 5-year fix opt for the variable to squeeze in at that 5.25.
Right.
Right. Because at 3.7 less a discount, you're probably 3.25 more or less. So plus 2 is 5.25. So you're at that stress test level
or above. Yeah.
But you see a 75 basis point bump on July 13th, and now the stress test is going to be exceeding 5.25. We could be qualifying people at 6 or 6 plus.
Yeah. Okay, so in this rising rate environment, then what can homeowners do to get ahead of their mortgage payments and not, lose their shirt?
This is a real good time to take hold of your financing and really understand what you're spending money on.
Mm,
And you talked about mental health and wellness earlier on the show, and June is focused to that.
yeah,
Financial wellness is also important. I
absolutely.
think everybody needs to take hold of their finances, understand what's coming in every month,
Yeah,
and what you're spending money on. And the only way to do that is to do a deep dive into your bank statements, look at your credit card statements, and take a look and see where all your money is going. You work hard for it.
mhm,
You are seeing everything go up.
yeah,
Where can you save a few dollars? Like, are you paying for subscriptions, monthly subscriptions that you're not using? Are you stuck on some pre-authorized debits for things that you don't even know what they are?
yeah, exactly.
Yeah. I had a client
Yeah,
recently. It was about just before Christmas, actually, so it wasn't that recent. But she had paid off a house 3 years ago, and they're still taking off the mortgage protection insurance from that previous house. She ended up having to show that she paid off that house to get a refund of all that insurance premium she paid for about 3 years.
oh, wow.
So, these are things people aren't paying attention. They're living paycheck to paycheck. They're living out of using their debit cards
Yeah,
and not looking at the statements because there's so many transactions during the day that you're using these tap, auto purchases that people just aren't paying attention.
that's
And
right.
I think it's so critical, so very critical to just take shape and see how you're spending your money
That's a
and
good
see
point.
if you could change something, see if you can alter 10, $15 a week, which ends up being $60 a month, 700 and change a year,
Yeah,
$700 that you could apply to something else. Or like, it's so important.
that's right. That's right. And just to put it in perspective, for people, when it comes to the interest rates, like right now, it went up. You said 1.25 since March 2020, right? So cumulatively this year.
We're talking about the variable.
Yeah, we're talking about the variable rate. Yeah,
Yeah,
exactly. So that amounts to what, $1,250 per year per $100,000, if my math is correct, right?
correct.
So okay, so just so people understand how much it's going to affect them if it affects them, but I think it affects lines of credit as well, right? Not just the variable rate mortgages; it affects lines of credit.
Yeah,
So people with HELOCs, for example, home equity lines of credit, if they're for every 100,000 you have there, it's going to cost them right now an extra 1,250. If it goes up another 75 basis points, it's going to cost them, over $2,000 a year extra, right? Sorry, not extra, but in total. And I think I saw a report whereby homeowners in Canada took out an extra $2 billion in February alone in HELOCs. Is that correct? Does that sound
yeah. It's
right to you?
still a popular product.
Okay.
Um, People are just lining up to get them. I
Mhm.
think there is some anticipation that the government could change the rules on HELOCs and the qualifying criteria on them.
Right.
So people are just trying to get in under the wire if those changes do take place.
Makes sense.
And, HELOCs are very flexible, but they're also costly. And, I always tell people you have to use your HELOCs wisely.
Yeah.
There are some really cool products out in the marketplace that allow you to use HELOCs and break them off into mortgage components. And although people like the interest only payment
Hmm.
on a HELOC, a mortgage provides you a cheaper rate of borrowing, although you're paying principal and interest on your payment. So, banks are very good at making money.
Hmm.
And one of the best magic tricks they use is they push people into lines of credits and HELOCs
Yeah.
because it's an interest only repayment, but it's usually at prime plus half a point. So, if you think about it, you could get a HELOC at prime plus 50, which is 4.2%,
Hmm.
soon to be higher when rates rise.
Yeah.
Or you could get a variable at prime minus 50, let's say.
Right.
So on the same money, they can make an extra point. So an extra 100,000, that's an extra $1,000.
Right.
right?
Got it.
So all of a sudden, they're encouraging people. Oh, you got flexibility. It's open. You can pay it off whenever you want. People don't pay off these things.
That's right.
People are always borrowing. It's they use it as a giant overdraft, and let's call it for what it is. HELOC balances are high, and people just need to know how to utilize them to lower their payments. That's what we do at owlmortgage.ca. That's what we do with all our clients. We tell them, take a mortgage component within your HELOC. It's cheaper. Yeah, but the payment's higher. You're saving money. You're paying off the debt.
Absolutely. And we actually had a real life scenario the other day. You and I talked about that, right? Where a client had was expecting the same monthly payment, but the interest rate came in higher, and they were a little bit upset because the payments were higher. But that actually
right? Well, that's the static variable versus the adjustable variable. And there's 4 banks out there that offer the static payment. It's a variable rate with a static payment. So what that means is you make your payment, but even though rates go up, it never changes. That is a terrible, terrible product.
Yeah. So people should be aware of that.
And people think that they have a deal. They think it's great. But the reality is at maturity, when you haven't paid anything off and you want to look to transfer your mortgage, you want to shop your rate, you have to transfer that mortgage with the remaining amortization left. And if you're behind, your payment's going to balloon, or you got no negotiating room.
That's right.
Right? When you take a variable rate mortgage, you are being qualified at a stress test rate.
Yeah.
The stress test rate is there, and it's designed because it's preparing you for rate increases. When you're on a adjustable rate variable mortgage, you are maintaining your amortization schedule.
Correct.
And as the client that we were involved with last week, when I explained that to her, the light went on, right? Exactly. And it went on when I told her this. Imagine making your payment for 5 years on a 25-year amortization. And at the end of 5 years, you find out that you have 33 years left to pay on your mortgage. And they said, well, how can that be? I said, well, your payment stays the same. You took your mortgage out in January. We've seen 1.25 point increases go up. Your payment hasn't changed, so less money goes towards your principal repayment. We're going to see another increase in in July 13th, and possibly a few more down the road.
Yeah.
So you may be in negative amortization.
Wow.
She goes, well, that's no good. I said, yeah, but your friends at the barbecue were all excited that they had a static payment.
Oh, that's right. Yes.
Can you imagine what their face is going to be like when in 5 years when they realize they just wasted their hard-earned money and they're not going anywhere?
Yeah. Yeah. Or the shock when they have 33 years left on the amortization after 5 years.
A number of years ago, Norbert and I came across a client, and this was from the 35-year amortization vintage. Okay. So this is back when those amortizations were still available. Right. And it was a TD Bank client on static payments.
Okay.
So they're up for renewal and they want to shop the mortgage. And we got their statement and they had 44 years left on it. And then I looked at Norbert. I said, Norbert, what's going on? I rarely do any business with TD, but I said, well, how can this be? Who offers a 44-year amortization? Is this a new product at TD or something? No, it's reverted. It's a static payment at TD. I'm like, they didn't give the client the option? Terrible. This is crazy.
Terrible.
It's absolutely crazy. So, these things happen. And this is why, I always explain to people, if you want a static payment, you're probably best to go to another mortgage broker, because you're not going to remember me telling you this.
Absolutely.
Right. And 5 years down the road, what happens, Lambros? Vince, what happened to me? Mm-hmm. You put me in this mortgage and I have 33 years left on it. I should have 20.
Yeah.
But I told you, it's a static. No, you don't. I don't remember that.
They won't remember that. No.
They won't remember, because when people buy homes, they want the key.
Correct.
They want the key.
Yeah.
And what's my monthly payment?
Correct. That's right. That's right.
They don't care about anything else.
No, exactly. Wow. Okay. So let's switch gears here a little bit. We just had an election last week, and love him or hate him, Doug Ford is back in office for at least another 4 years. But he did spearhead the home affordability task force. task force. I can't even speak today.
Yes.
And I think you read that, and you took some good takeaways from that as well. So do you think it's actually going to materialize? Because I know there's been a lot of resistance, or you're assuming there's going to be a lot of resistance to it, right?
Well, the task force wants to focus on eliminating red tape.
Hmm.
They want to try to move things along a lot quicker.
Okay.
This NIMBYism, they want to change it to YIMBYism. They want to
Yeah.
change not in my backyard to yes in my
Yeah.
backyard.
I got it.
And
Yeah.
I think they're going to provide the municipalities the tools to do that. One of the things that I think they're going to be implementing quickly is these appeal processes.
Okay.
There's just a $300 charge, $250 to $300 charge to appeal an application, and they're going to quickly change that to make it $10,000, non-refundable.
Okay.
So if third-party people want to try to slow down a development that has affordable housing in it, they're going to have to pay a lot more than $300. And I think that's going to be a bit of a sticker shock to some, because the reality is nothing gets built in this city. I had this conversation earlier today with another colleague, and we had our accountant in, and we're chit-chatting about, well, things are moving quite fast. Well, not in the city. In the city, they're not moving fast at all.
No.
I live, and I don't know if I've mentioned this story to you before, but I live at Allen Road and Shepherd area. I'm in a little community there.
Yeah.
And across the street on Wilson Heights is this parcel of land by Canada Lands.
Yep.
And I've lived in that area since 1998. And there's been a plan to build low-rise, high-density units in this parcel. It's got to be maybe 10, 15 acres, probably more. It might be 20 acres. It's between Wilson Heights and Allen Road, between the two subway stations of Shepherd and Wilson.
Yep.
Great place by transit,
right,
by a major artery for high density.
Sure.
We are now 24 years, nothing gets built.
Wow.
The only activity I see in there are people flying kites. That's it. 24 years they've been trying to build there. And community groups, politicians fight over this. And the reality is how can you continue this activity and you want to talk about affordable housing?
Yeah.
Right? It's just, until I see it, I'm not going to believe it.
Yeah, no.
And the mandate to the Ford government was clear. Like he got more seats than he came out of.
He did.
We need to have all party lines aligned on this topic. I heard an interview by somebody about Andrea Horvath, and listen, I'm sure she means well, but she was referred to a Karen. She'll criticize everything. And the line I heard was, how can you have people trying to work together when if Doug Ford would cure cancer, she'd probably complain about the cancer research staff that lost their jobs. Like that's what these people do. Like, work together.
That's politics, though. I mean, that's.
I understand, but there's no progress.
No, exactly. There's no progress. And it's in everything, though. I mean, it's worse in the U.S. With all their issues, gun control, abortion, all these things. And here we see
it's just divisive, right? And
exactly.
I applaud Ford for working with Trudeau and the federal government on bringing jobs to Southwestern Ontario.
Right.
During an election campaign, you have a liberal government, federal government, working with a provincial, conservative government to get jobs in Southwestern Ontario, factories built, funding for these facilities. That's what you got to do to make things work. You got to work with people.
Absolutely. Yeah, they have to work for the people and not just worry about their reelection.
I agree.
Yeah.
So I think we may see some changes. I think it's all process-based.
Okay.
The shovels in the ground are going to take a while.
The little shovels that Doug Ford was using for the snow, or real shovels? Remember I don't know if you saw the. Sorry, I'm going off tangent.
No, I know. Listen. If he could start with that shovel, see, at least it's a shovel.
That's right. At least it's a start, right?
But there's a long way to go
Okay.
before that happens. And with rates at these levels, I don't know how developers are eager to push shovels in the ground because they won't make any money.
Yeah. Wow. So, I mean, speaking of making money as developers, I mean, how much of their costs go towards some of these soft costs, and how much goes to the government, and how much? Do you have any idea of how it breaks down?
You know what? The Ontario Housing Affordability Task Force
Perfect.
does cover that.
It does. Eh? Okay. Excellent.
And government charges on a new single detached home average roughly $186,000, or almost 22% of the price across 6 municipalities in South Central Ontario.
22%. Wow.
For a new condominium apartment, the average was almost $123,000, or roughly 24% of a unit's price.
Okay.
So if the government wants to get serious about building homes,
Yeah. And making them
maybe
more.
they got to get rid of all these charges.
There you go. Exactly.
Right?
Yeah.
So, like this is right out of the task force report. Like, if anybody wants to cry and laugh at the same time, read this. This is an unbelievable document and research.
You can get that on. You just Google it, right? I guess.
Yeah, it's the Ontario Housing Affordability Task Force.
Okay.
Highly encourage people read this so they understand what the gaps are. A lot of challenges. There was one thing I read here, and I think you would find this interesting because there's a whole bunch of little anecdotes and stories about what they found. So the theme here was new housing is often the last priorities by government. Okay. And it talks about a proposed building with market and affordable housing units would have increased the midday shadow by 6.5% on a nearby park at the fall and spring equinox. And I'm making this up.
Okay. Got it.
With no impact during the summer months, to conform to a policy that does not permit new net shadow on specific parks. 7 floors of housing, including 26 affordable housing units, were sacrificed.
Wow.
Multiple dry cleaners along a transit unit were designated as heritage sites to prevent new housing being built. It's hard not to feel outrage when our laws are being used to prevent families from moving into neighborhoods and into homes they can afford along transit routes.
Wow.
So these are the red tape and roadblocks developers are dealing with. You got people trying to designate cleaners as heritage
multiple dry cleaners. So that's
6.5% shade on a park in the spring and fall.
Wow.
Like, this is the type of shit.
Yeah.
And I really think it's shit.
Yeah.
To prevent people from moving into homes.
Oh my.
The conversation today is this morning I had was about transit.
Okay.
You think of the Bloor line.
Right.
Okay. We have a major artery. The Bloor line stretches from Etobicoke all the way to Scarborough.
Right on.
Every station should pop out to high density. You come out at a station on paper, whatever, you got single family homes next door to the station.
Yeah.
It makes no sense. It makes no sense. And these are all communities that will not promote affordable housing or high density.
Yeah. Wow.
I don't know what the answer is, but we can't continue down this road and think that people are like, we're four season country. People can't live in the park in a tent.
No, for
That's
sure.
work.
Wow. So what about appraisals? What are you seeing now with appraisals? Are they coming in at purchase price? Are they coming in below, with prices coming down, or are they still, coming in over? What are you seeing?
Very good question. I had a great chat with Claudio Polito. He's the president of Crosstown Appraisers, one of the more high profile appraisers in the city.
Okay.
Properties purchased in March and April are coming off a little bit low. They're not coming in at value.
Right.
But I don't necessarily attribute that to valuations. I attribute that on bad mortgage personnel dealing with the file. Okay. If somebody is buying a house, you
Okay.
get the appraisal done right away.
Got it.
Okay. Appraisals on properties being purchased today are coming in at value. People are paying what the house is paid, what it's worth.
What it's worth. Yeah. Okay.
But when you have professionals, whether they're bank specialists or mortgage brokers, that are waiting to order appraisals in a market where the knife is falling, you're trying to catch a falling knife.
Correct.
You can't be waiting to order an appraisal. You got to order it right away. As soon as that offer is made, get that appraisal done. And you take that whole issue out of the equation. Where we're finding problems are people that bought in March are trying to close a deal now, and no appraisal was done because they were shopping, they were dealing with someone who didn't know what they were doing,
Yeah.
and now they're upside down 150, 200 grand on a purchase versus value, and they got to come up with the difference.
Yeah. Yeah. No, that's an excellent point.
It's a challenge.
Yeah.
Right. And this is where I think the novices are going to get slaughtered. You know, when you're dealing with people that don't know what they're doing, they're going to cost you money. And it's cases like these that cost people money. You're not dealing with a pro.
Yeah. Yeah. No, great point. That's an excellent point. It's something probably a lot of people didn't even think about. Yeah.
But right now, in the last couple months, values are coming in. It's stuff that is I call them the mistakes. The stuff that, you know, people bought before they sold. We always encourage people to sell before you buy, so that way you know exactly where you stand, you know what you're buying. But a lot of people, you know, they want to buy, and they're afraid that they don't have choice. And I don't want to rent if I can't find a place if I sell first.
Yeah.
It's like, is that the worst case? So you pay rent for 6 months? You move twice,
Exactly.
as opposed to losing 150 grand on both ends of the transaction. Like I don't know.
Exactly. Sometimes short term, you know, they don't look past that, right? So
Yeah.
consider the long term. Speaking of long term, though, I want to jump back into interest rates for a second, because you mentioned March 2020 and everything, interest rates just fell, and people were, you know, taking money out like it was going out of style. So now we're already 2 years in, 2.5 years. A lot of those people, I'm assuming, took out 5-year terms. So if the mortgage rates now are increasing, maybe they'll settle around, you know, that 4 or 5% mark, maybe 6% mark. Who knows where they're going to go in 2025? What do you think is going to happen with all these people who were able to take out mortgages at, you know, dirt cheap rates, and all of a sudden they're going to jump up to 5-6%?
You know, we have this conversation quite a bit with our clients, and if you are the beneficiary of a rate below 2%, you should be spending a lot of time in your mortgage contract on the prepayment options. And if you got 10, 15, 20% prepayment options, plus the ability to double up your payments, I would be hammering down that debt with this cheap money.
Got it.
When you owe less money, rising interest rates impact you less. And I use this example a lot. If you have $200,000 of a mortgage today at 5%,
right,
you're paying $10,000 in interest.
Right.
If you could hammer down your debt to half of what you owe by the time the rate doubles. So if you owe 100 grand when rates get to 10%, your interest cost is $10,000.
Yeah.
You're always paying the most amount when your balance is the highest. So the key is to shed the toys, do some budgeting, and see how much you could pay down on your mortgage. Now, let's use an example. If in 2020 you took out a mortgage for $500,000 at 2%, you're paying 10 grand in interest. You qualified at 5.25. So you were qualified on the basis
was it 5 back then? Was it 5.25? Was it 4 point something?
Well, it was about 5%, 4.49 or 5.25. That's the qualifying rate.
Got it.
So let's use 5% for argument's sake.
Okay.
So you were qualified on the basis that you can afford interest costs of $25,000,
Correct.
right?
Correct.
So there's a $15,000 delta there. You should be making your payments or doing whatever you can to use those excess funds to pay down that debt.
Yeah.
Right? Because if you start off at 500 and by the time 5 years comes around, you could nail that thing down to maybe 350.
Wow.
That's not bad. That's really good. You have accelerated your amortization schedule to a lower time frame.
Yeah.
You owe less, and when time comes around for renewal, which everybody's panicking about or starting to worry because we want to try to make people feel comfortable.
Yeah.
You have to realize that when you owe less, you're in more control.
Absolutely.
And I think that has to do with financial wellness. I think it has to do with mental health.
Yeah.
Eliminate the stress. Understand that, okay, you qualified at this income.
Yeah.
You're going to get 1, 2, 3, 5% raises every year. You're probably going to earn a little bit more.
Yeah.
Now, families change. The dynamics change. You might have a new family, kids, people going to college. Various situations happen in 5 years. It's a life cycle.
Absolutely.
Period, right? So a lot of stuff can happen.
Yeah.
And you just got to be aware of what's coming and plan.
Yeah. Yeah. Couldn't agree more. Absolutely. There you have it, folks. Great advice from Vince. So it's not too late if you are. If you have those prepayment options, absolutely use them.
Take advantage of them. Oh my God, those things. Less than 15% of people take advantage of these things in these contracts, and they're there to help you. They're there to give you a privilege and an ability to accelerate repayment. Take advantage of them.
100%. 100%. Great. Awesome. Vince, that was great information. Thank you for sharing all that.
Thanks for having me. I really appreciate it. I always enjoy coming on.
Thank you.
It seems the time just flies by, and we cover
We're
all kinds of fun
40
things.
minutes almost here. So I know you like people following you on Instagram there, where you provide a lot of great content. I see you almost daily on your reels, providing some great
Thank you.
tips.
Thank you. I have a lot of fun with it. I feel 15 years younger, Lambros.
By all means. And you look 15 years younger in person too. So.
Thank you. Thank you.
So follow Vince at Vince G Mortgage on Instagram. Or if you're not on Instagram, you can call him directly. He's always willing to help out. Any parting words, Vince?
You know, folks, I would really try to focus on enjoying your summer. You know, the good of this is the weather's better. Everybody could be outside. Enjoy some time with friends and family, and don't talk real estate.
Yeah. Great point. I love it. Okay.
All righty.
Thanks, Vince. Thanks, everybody.
Take care.
Take care. Have a good one.